Hey everybody, good afternoon. Happy Monday. Welcome back. It is just after 3 o'clock. Welcome back to the final hour, July 7th. Hope you all had a great holiday weekend. Thumbnail today, how tall is the wall of worry? Last Thursday, the market was only open from 9:30 to 1 p.m. Eastern time and ripped up about 0.9%. Today, we actually had the VIX up a little bit, ended up spiking up a little bit towards $18, as high up as, let me see, the intraday high. High at 1850 today, and it's currently trading around 1784. I looked at the potential move in the S&P around 1.06%. We actually exceeded that. Let's take a look at the breakdown this morning. When trades started at opening bell, this is the kind of intraday VIX. We had a gap up around 3 a.m. Eastern time. Around noon, things got a little bit more elevated. Here's a short-term look at it. So the VIX kind of cooled off in the morning, opening bell right around 17 and change. Just did the little rule of 16, looking for maybe like a 1.1, 1.15 move on the S&P today. And we ended up spiking up, 18.5, which at that level, 18.5, looking about a 1.15% move on the S&P, and we had like a 1.23 if you go to the close from Thursday. So close there, drop down about 1.23, so just a little bit of an overshot. We'll see if we end up coming back down to the floor around 6,200. This morning's level, this is why in daily profit play I didn't want to call the bottom. We had levels around 62.30, 25, and 20. We did end up breaching those levels, some updated gamma levels, 62.25, 6,200. Potentially a level here around 61.80, and some volatility. So things just kind of rolled over a little bit. I mean, the market is down about 1% from the recent highs. That is totally fine. I'm hoping that we have at least a minor correction coming into, middle of the month, end of the month. I do have some short-term bear call spreads. I took one on the Q, one on AVGO, took a couple of stabs, nothing crazy. I'm hedged out, at the end of the year in case things get a little nastier. But at the very least, I'm just looking for some type of pullback in this cluster of moving averages. The only one that's been tested since this U.S.-China trade agreement gap, or this pause, was the 21 period. We tested the 21 there, we tested 21 there, and we've gone up. Now, it was the 5-wave count that I talked about this morning in some sessions. Wave 1 on the April 7 low, ripped up on the 9th. So there's a 1, pullback 2, push up 3, pause and pull back 4, and then this kind of capitulation move, ceasefire got a little bit more love to it. There's a wave move. Now that was enough to take out these recent highs. Let me go back to COVID. I've drawn some correlations and parallels to what we saw with COVID price action. Let's see if we had kind of a 5-wave structure up to the all-time highs again. It was kind of similar before we saw a pause, right? So we see 1, 2, 3, 4, 5. Market pulls back here, right? This is the crash. 1, 2, 3, 4, 5. Not at the all-time highs, but we do have some pullbacks, and the market pauses and then proceeds, and we have another correction. So, I mean, I get it. The market's at all-time highs, or was at all-time highs. We're pulling back a little bit, but it's just simple price action, some wave structure, and I'm not, a huge Elliott wave person, but I can see some waves pretty clearly, and it seems like this is what price action has done from this run. 1, 2, 3, 4, 5. Very least, I'm looking for an ABC, right? So if we have an A, B, C, there's a couple ways this plays out. Either this is a wave 4, that's the top there, a wave 3, the bottom here, a wave 4. So I'd say area 1 or area 2 would be pullback levels for me to be looking to position for some dips. I want to position for some pretty wide margin for error. For starters, to make sure like the coast is clear, make sure the market is stabilizing, to make sure things aren't getting worse. Because as we saw things rotate aggressively and get worse and get way worse, prices fall very quickly, as we know. So depending on how high the VIX is, for example, if we do come down to this area, if the VIX is up into the 20s or 30s, it might be worth taking on some, some premiums, like sell some premiums, try to get some out of the money. puts or some 1-1-1 strategies or something like ratio spreads where I can sell some premium at a high price and hopefully go out, I don't know, 60 days, 90 days, maybe out to the end of the year, try to position to see if I can be, as long as price doesn't take out this low, there's my line in the sand, and get paid on that for a certain duration. Okay. But correction levels, I would just be highlighting some type of 1, 2, 3 wave move. Okay, so somewhere in these two horizontal levels that pulls us back just below 6,000. So we'll go just less than 6,000 on SPX, and maybe somewhere around the 5,700 zone. Not perfect science, but to me, this is where the market would kind of check. And we have a 50 period here, a 100 period, a 144, and a 200. All I really want to see is price try to get there. Obviously price can go sideways and sideways and sideways, and these moving averages can continue to climb up and catch up. And if they did that and they roll through them, then that might be a sign of something worse. But I think if we just have like a quicker correction and price can fall to them all by itself, I think price will be picked back up and then kind of stabilized, and then we'll see if we get back again. But I would say if we roll over a little bit here through the second half of July, August, September, I wouldn't be expecting anything really impressive to the upside. I would say at best, maybe just corrections, and then we see if we have a strong push out of, maybe mid to late October into October, November, December to finish out the year positive. It's crazy. Like we're already at the halfway point, and you got to wonder, it's like, okay, so based on probabilities, we're probably in the clear for the market not taking out the lows by the year. But that's why my thumbnail today was, how tall is this wall of worry? I was asking some this morning and some fellow experts. It's like, look, if you had a column of positive things for the economy, positive things for the markets in one side, and then negative things for the economy and the markets on one side, which side is bigger? Like if you just classic column like the T, right? So you've got your pros and cons. You've got your positive things for the economy and the markets and the negatives. Something tells me that a lot more negatives are starting to stack up more than positives. Okay, because the positives that have been happening in a way have been mildly priced in my opinion. Everyone's excited about Trump. Price. Everyone's excited about the Fed maybe cutting rates in 2025. Pricing in or priced in. Everyone's excited about AI and what it can mean for corporate profit margins. Pricing in or priced in. Earnings season for these next 3-4 weeks are going to be really critical to see, like, are these companies as good as everyone says it is? Is it justified that the US is at 24, 25 times earnings? Maybe, right? What's forward guidance through this window? Everyone kind of forgot about forward guidance because nobody knew what to say in the last quarter. And the markets didn't really care. We do have some, in good faith deals, like we announced one, celebrated one with the UK. It's not done. We just announced it. We had one with China. It's more of a pause. There's a back and forth collateral on, with what is it? The like the raw materials, whatever it's not raw materials. It's like the refined materials. I don't know why the name is slipping my mind right now. But anyway, that's China's bargaining chip to everything we're doing with tariffs. Vietnam was announced last week. Saying, like, are these deals actually done? No. The tariff deadline is the 9th. Are these deals done? No, they're not done. So, Scott Bessent coming on headlines today and saying we're inking some more deals, or we're talking more deals. We'll announce some more deals. It's like, okay, on paper, sure, announce something. But is it just to pacify the market and make it seem like everything is great? We're just still talking. It's open window until August 1. Like, who knows? So how does the market take it? Probably fine, but I just think a correction is needed. I don't think it's that hard, right? If a correction happens, I'm looking somewhere between about 4 to 10%. I know that's a big difference, but 4 is from this recent high. Fill this gap here. That's around 4%. That's the ceasefire gap. Take out this previous wave 3 high. That's around 5%. Pull back and find the wave 4 bottom. That's 8%. So I mean, realistically, I'd say between about 4 and 8% on the S&P, and probably about 5 to 12% on the Nasdaq. Okay, it doesn't deter me from being a bull in this market. I'm certainly cautious at the all-time highs right now, at least waiting for a correction, at least waiting to deploy some capital at better prices. Wonder if the big beautiful bills have been priced in. Rare earth, thank you, Jim. Jeez, I don't know why they'll slip my mind. Rare earth, yeah, exactly. The big beautiful bills priced in. Part of me thinks moderately, yes, but now you have the Trump versus Musk, round two, more of the bickering back and forth, the America Party, whatever that means. It's like I think it's just a bunch of noise right now. It's going to be more important during midterms next year. I mean, if Elon Musk really wants to prove a point and wants to get some big money behind this cause of the American Party, 2026 is the time it's going to shine because we have midterms. I don't even know how this whole thing starts. I mean, it's been a two-party system forever. I know you have independents, you got the Green Party, and you got this party, but nobody sees them on the ballots that you know of. So I don't know. It's going to be weird how this plays out. This may not even matter until midterms. This may not even matter until the election in 2028. It might be that far out. But the big beautiful bill, I almost think like I don't know. It's almost like we're aware enough now to realize like raising our debts by 2, 3, 4 trillion dollars, cutting benefits for 10 plus million Americans. I don't know. I mean, if you just do some basic skimming, you can have AI do a summary of the 960-page big beautiful bill and show you all the pros and cons. I'm sure AI does an okay job. That's better than taking someone's word for it. That's better than not knowing anything that's happening. So there's a lot to unpack, obviously, with the 1,000+ page bill. But I do think this is kind of forced and stuffed, and there's threats of if you don't vote for this, you don't pass this, then you lose your seat in the midterm. That's kind of the political threat. So I'm sure it's getting passed. I know it was back into the House for reconciliation last week, whether that is being voted on or has been voted on. The idea was to get this bill, passed by the 4th. And again, it's like now it's the 7th. Now we have a 9th deadline. The bill can't be all good. It's good for the top. I don't see that it's good for everybody. I don't think that we are out of the clear yet with inflation. I don't think that tariffs have really been fully felt by the world. It's really simple. I listened to a good podcast this weekend. Look, so you have tariffs. Okay, there's two ways this plays out. Okay, if this is tariffs for deglobalization, this is going to be inflationary, right? So let's keep it really simple. If tariffs make things harder to get, that's inflationary. If tariffs change prices on things we have in everyday life, it's inflationary. Okay? If we are putting in forces and components into the global economy that are making things harder to get, more, too much money chasing too few goods, that's inflationary. If our trade agreements, if our trade partners are changing terms and going to seek partnerships elsewhere, that's inflationary. I don't think that this is all sustainable, but China has certainly been looking at other trade partners. They're increasing like trade deals to Canada by like 20%, trade deals to the European Union by like 12 to 15%, trades over the Middle East into the double digits. I mean, China's a national player. I mean, we know it's international. The rare earth stuff, the raw materials, the refinements, everything that China does that's been, we've basically handed them a global manufacturing power that now we're asking for some of that market share back or some of that money back. And we as consumers just like buying cheap stuff because it helps our profit margins. So deglobalization, which is what I think ultimately tariffs lead to, because it's adding stricter trade policies, it's adding different pricing structures, and I know that the idea was after the fact was trade more, not trade war. I know that's how they spun it. Sounds great. Is it actually happening? Okay, globalization is what we've been experiencing that we are just now putting away. Like globalization is how China came to power for the last 30 years. That's how Japan survived a 1989 market crash and has come back in a big way. That's how the US has been at the top of some of the biggest companies in the world that are larger than tons of countries. Globalization. But we can't do it alone. We can't make stuff alone. If we tried to onshore anything, unless we're doing it with full automation, these manufacturing plants, these plans, these big beautiful plans would take years and years and years to be online. And I don't think they're bringing back jobs. I think they could bring back, you know, products. I think they could bring business to the US, but I think it's years away from actually becoming a reality. So I do believe that the market is forward thinking. I think the market is typically 6 to 8 months out. A lot of things in that 6 to 8 month window that have been ignore the trade war, focus on trade more, focus on AI, focus on how corporate profits can be better, focus on like all the good, right? That's what the market's been doing since April 9th. We focused on all the good. And here we are with one of the biggest vol crushes in history, one of the fastest recoveries in history, and we're sitting at all-time highs. Okay. So I don't think it has to be incredibly complicated. I just think that if we don't really know where we're going and the US hits like a stall, that's not necessarily the US declining or falling or going into a bear market, but a stall in the US's growth, a stall with higher either sticky inflation or higher yields right now. I think that is a problem, you know. So that's what I'm saying. Like the wall of worry, it's still there, and the market's done a great job of climbing and climbing and climbing. But at some point, you wonder either that wall of worry is so big it's insurmountable before a reality check happens, or the market's like, okay, we've done some pretty amazing things recovery wise. Now it's time to say, okay, market, prove it to us. Prove to us that we're right. Prove to us that these movements over these last 60 to 90 days have been right, right? i.e. earnings. That's probably the biggest thing. So I talked about this morning, but one way to play this, in my opinion, just as a barometer, would be looking at some of these sector performances. Okay, typically earnings season kicks off with financials. You can take a look at the calendars. If you go to StockTwits and look at next week when we have earnings. Next week, so we have a couple sprinkled in this week. It's nothing major. I think Delta's one of the bigger ones. ConAgra. Trying to think. Delta, ConAgra. I saw, what was the other one? Levi Jeans, maybe. But let's go to next week. So the 7th, 14th. Okay. So picks up a little bit more next Monday. Here's where we start to get into financials. Wells Fargo, JP Morgan, PNC, that's a bank. PGR, that's Progressive. USB, Travelers Insurance, PepsiCo, Schwab for some investing. I mean, look at this. Friday the 18th. I don't know if this is accurate as of right now, but you're going to load 457 companies up on a Friday. And then the following week is where it gets much bigger. Now we're talking Taiwan Semiconductors. Now we have Coca-Cola and Google and Tesla, AT&T. We have a bunch of other ones. I mean, this week, 1, 2, 4. I mean, there's 600 plus companies reporting on the 21st. You're coming into an OPEX or a monthly expiration here. And that might be why there's so many expirations here for that Friday. But, I mean, not a ton of earnings outside of financials. That's why I'm going back to XLF. Because if XLF through earnings is going to be down or up, I think that sets the tone through earnings season. So, what would banks be excited about? Maybe the Fed cutting rates, and maybe their margins improve a little bit. Maybe they have what it takes AI-wise to start cutting white-collar jobs. Tech's been cutting jobs. Microsoft laid off 4% of the global workforce. Maybe it's going to be seen in banks next. Maybe it's going to be seen in healthcare next. Maybe this AI stuff is going to start broadening out to other sectors where it's not just thinking it's tech, it's tech, it's tech. Because one thing that's interesting about tech is CapEx spending is a monstrosity. Like all the profits that we know and love Mag 7 by, that is an arms race into AI. And I think they benefit from it, but maybe not to the degree of profit margins that I think everybody's thinking. So maybe AI needs to broaden its reach and spread its wings and go into other sectors. Make banks more profitable, make healthcare more profitable, make other sectors, I don't know, boring old utilities, basic materials, somehow make manufacturing more profitable. I don't know, and this is a reach, but forward thinking, this is where I could see the market still grinding higher. Would be something where AI is now everything. Everything has to be AI. This is the future. This is what the next 5 or 10 years looks like. This is how the market's going to maintain these high valuations and justify them. Okay. But if we go into earnings season with more trade policy uncertainty about the Fed, I don't know how the market can sustain these highs at these valuations when it's easy for things to go down. right? At least have some reality check. I mean, price to earnings at 25 that condenses to 22, compresses to 21 or 20. During COVID, I think we were like going into COVID, pre-COVID was like a 21 or 22 times earnings that ended up crashing down to like 17 or 16 before it bottomed. So, I mean, having 4 or 5 points on the price to earnings and then finding a bottom. I mean, we were down to, I don't know, I want to say we were down to like maybe 17 price to earnings this year during the April correction. So March and April, things rotated hard. We had like a 30 times price to earnings on Mag 7. And that 30, I think it was like 30 to 33 times earnings compressed down to like 22 or 23. The broader market compressed from like a 20, 23, 24 down to like 17 or 18. Found a bottom from there. But I just think a little pullback. So I'm trying to keep it really simple. Charts on the S&P and the Qs tell me a 5-wave structure is going to pull back, a little 1, 2, 3, somewhere between about 5% to 10%. I'm still a bull. I'm still going to position accordingly. The reason I bring up financials is because this is where we usually kick off earnings season. Are we going up? Are we going down? This is something to watch. I want to see the following. I mean, honestly, if we started lower, but then we build back from there, I think that's a good spot to be like buying dips. I think buying dips is totally fine. The hard part for me is if we blow out these highs and we expect this market to keep running hot. I mean, a sector doesn't look like that, right? This sector doesn't look like that. 1, 2, 3, 4, 5. We don't look like that. I think that all these, look at the structure. 1, 2, 3, 4, 5. So do we go and finish this move and then fall back in? Maybe. I'm really cautious on the charts to buy into these highs. So I'm waiting. I'm waiting for dips. Doesn't have to be that hard. Find a consolidation period. Find a pullback into some moving averages. Your favorite stock could be the same thing. You like Nvidia right now. Cool. You like Nvidia. Well, this thing hasn't pulled back to a 21 period since literally May. That is a tiny, tiny, tiny pullback. Can we get something? Pull back to the 21, pull back to the 50, pull back anywhere. Be better than nothing. Okay, how about Broadcom? Same thing. We ripped up and touched the 21 for a day. And it's just been straight up 100+% off the lows, if I'm not mistaken. From this low to this high, 100.3% on Broadcom. I think just a little bit of ventilation goes a long way. Right? CLOV, I don't even know what that is. Clover Health Investments. I don't know. My question is, was this a SPAC back in the day? Was this a SPAC back in 2020? Something tells me it was based on how this price action played out, because this looks like every SPAC play that there was in 2020. Started off, had a couple of highs, and then crashed down to garbage. The fact that this was dead capital below $1 makes me very, very not interested in it, but I will take a look and see. I'll look and see what it looks like fundamentally. SMC, I will take a look. Yep. Let's go to. There's ways to play that, Jonathan. Grains, commodities, yes. Grains, not necessarily. I mean, I think we have. I don't know. I mean, I'm not in that space enough to know like what's going to happen to farmers, what's going to happen to wheat, corn, soybean. I mean, you'd think we have lots of it. I know lots of dairy farmers that literally water. They like milk their corn silos because they have so much excess milk. I think we have an incredibly efficient agricultural system that somehow is like wasted, or we're never going to see like higher prices. I don't know. But precious metals, rare earth. I mean, we've seen a run in a lot of things recently. I mean, obviously oil spiked, but we're seeing platinum make a run for it. Gold and silver have been doing pretty well. Copper's been on a pretty good run. Aluminum's been on a pretty good run. So I definitely like the commodity space as a whole. There's ways to play that. I've looked at DBC for a while. That's a commodity index tracking fund, which has had a pretty good rip here from around sub 20 to up to 20, $23, which doesn't seem like a lot, but in the commodity space, going up about 17 to 20%, not nothing. You look at one here called GNR. This is Global Natural Resources. We rallied from like the $45 zone up to 55, a $10 move on, for the most part, like a pretty choppy instrument. This is up 25%. So I don't know if there's like individual plays or picks or companies that I would say this is my play in commodity because I have no idea. But as a broader market, if broader commodities are going to go higher, if the dollar is going to continue to weaken, we have like a secular bear market in the dollar, then yeah, I could see commodities being a good investment. I could see them being a good diversification. But I don't know. I just think like if we go to all time highs, it's still an easy market, right? The melt up continues. We go to all time highs. Everyone enjoys whatever the next bubble until it breaks, right? But I'm still more of the mindset of like I'm still a trader. I'm a trader in this market. I know that we're back at all time highs. All this has done is made things a little bit easier to allow people to eke out some gains for the year. And now, I mean, think about smart money for a second. If you are, like a I don't know, like a low volatility based fund, what are you doing right now? Like, is this the point when you look at the index and you're like, now we have to buy? I mean, what a terrible time. I mean, I still think that even smart money that has been missing out and potentially not participating in much of this recovery at all has, given the retail trader a lot of props for buying the dip. And the retail trader's been rewarded for a long time by buying the dip. It doesn't mean that retail traders are the smartest traders because their risk is terrible. But if they have the courage to buy things and they buy things with speculation, they buy things with leverage instruments, they have a lot of money, like money making opportunities. But I think smart money, if they're going to participate, the ability to pull back into here can give good, big funds the chance to position without having a giant crash and then a giant rip. So we find like the equilibrium, right? Equilibrium can then be, okay, we can stabilize in here, we can accumulate in here, and then that next breakup can get us up to these highs with some profits, and then we can have a distribution phase and then another break. I mean, we can continue this trend, but I just think some type of pullback or equilibrium is needed because I don't think smart money is necessarily just buying all-time highs. In fact, I know they're not. You know, they play defense for too long. They sit on the sidelines for too long. They don't allocate quickly enough during these big movements because we're talking trillions and trillions of dollars. You can't just toss money at things like that. Okay, so anyway, the retail trader has been rewarded nicely. I still think the retail trader pretty much managed risk awful, which is why it's all over the place. But for a retail trader that can protect the downside, I think you're in great shape because you've had an awesome recovery since April 9th. April 7th really was the bottom. But as long as you have some type of, either cash on the sidelines ready to deploy or you have some type of downside protection in case we do have a 5 or 10% correction or deeper, I mean, I would still survive. If the market came back 5 to 10%, I'd still survive. If the market came back 20%, I'd still survive. If the market came back to test April lows, I'd still survive. I'd still probably hang on to most of my gains for the year if that was the case. So anyway, I mean, I was listening to some good macro stuff this weekend. I'm seeing targets at 6,500. I'm seeing targets at 7,000, and I'm seeing targets back to 5,000. And I'm seeing targets down to 4,400. That's a wild range of where smart people are telling me that the market could go. I mean, so everything that I take in is a grain of salt because I don't know where it's going to go either. But I would say that right now, a dip I want to position for. I think the market melt up is for real. I don't think the market has all of the commentary, the negative, just like all the negative, like I was going to say negativeness, the negativity that was just piling on through March and April. I think that the Trump administration has pivoted so hard that they will do basically anything to prevent the lows from being tested. And that's where the retail trader is benefiting because if we are seeing the entire market go down, who pivots? Right? Who remembers that conversation in 2025? Where's the Trump put? Where's the Chinese, President Xi? Where's his put? Where's Powell's put? So basically the whole market's like, where's the bottom? Where's the bottom going to be? How bad can things get before somebody steps in? Well, it was Trump, and he stepped in April 9th. That was the pivot, right? And from that point, I think now it's on his radar. Bond market has to be stable. Talk through this trade war. Pause this world. Get countries to hopefully jump in line and negotiate and talk growth. Growth. We're gonna be, winning so much you're gonna get sick of winning. That's now the spin. Whether it's true or not, the market's taking a lot of the stuff with optimism and in stride, which is why we're back at all-time highs. Okay. So, I mean, I would say that the Trump put is right back down near April lows, probably higher than that. I think the Fed put is probably way lower than that. I would imagine the Fed put's probably going to be at the 20, 25, 30, maybe 35% pullback zone. But the Fed's going to cut rates and the market already knows it. So if that's not changing, I mean, the Fed's not going to do anything for this month, and unless inflation is crazy, crazy high at the end of the month, or this inflation readings come out next week. But here's Trueflation. Okay, this is third party kind of giving us some real term trends. Look at what Trueflation is showing. So we were at 1.22 all the way back up to 2 point something, like almost a 0.9% increase. So this is 1.22 up to the recent highs at 2.27. That's a 1.05% run. So we had a swing of about 1.05% to the upside in real-time inflation metrics. Now we have fallen from 2.27 to currently 1.75. So we're down about half of 1%. Now, that doesn't mean that your headline CPI is going to go, tick for tick with 1.05 and 0.5, but heading into next week's CPI, I don't know if there's a forecast for it yet. I don't think that there is. They usually put them out like the week of because the market tends to get a little bit sketchy on it. But let's go to, what was I trying to go to? The Fed watch tool. Okay. So we're back into now seeing that the Fed might only cut twice this year. So 95% chance at the end of this month, there's going to be nothing, a pause still from the Fed. I want to go to the Bloomberg news as well to see what the next week's CPI PPI combo looks like. But there's a 63% probability that they cut in September. So there's July 30th, nothing for August. September would be mid-September on the 17th, 62.8% chance that the Fed cuts rates once. There's your one cut. Then it would be December. There's your two cut. Then you go into the new year, maybe a cut in Q1. So 1, 2, 3, 4, 5. So this market is still looking at 5 cuts by basically the end of 2026. Okay, so by the end of 2026, we are 1, 2, 3, 4, 5 cuts at roughly 0.25 each. We're going to be 1.25% lower on the official cash rate for the Fed. Now, will the 10-year yield be down by the same amount? Is the 10-year yield going to be still sticky around 4%? This is what nobody knows. This is the power of the bond market to kind of tell us, right? So I think this is also why the Fed was so cautious, because last September, their rate cuts backfired. They backfired and yields went higher, right? They cut rates by 100 basis points, yields went higher. So if they cut, I know it's 25 and 25 and 25 and 25, but there's all sorts of stuff that's being thrown out there like, oh, they cut in September, they're going to cut more. In fact, I want to say that maybe one of the Fed, I don't think it was a Fed chair, but I think maybe Bessent said it, maybe Lutnick said it, that if they don't cut now, that they might have to cut more later. Again, it doesn't show up in the futures market. These are sophisticated things that we look at and trade, right? So my point is, if we're getting 5 cuts by the end of 2026, will that 1.25% roughly translate into the 10-year yield going down by 1.25%? To me, that's a huge question. And if it does, great. Then things probably look better. And this whole soft landing, a no landing market can grow its way out of it. Maybe that's the case. I think the big outliers, like, does something break along the way? That makes sense? Like, if something breaks, that's usually where we have a forced intervention. That's usually where there's tons of victims and casualties along the way, but there's also a ton of opportunity. And so it's like having cash at the ready, having the patience to wait for some type of big opportunity to then position for it. And it may not be like, I'm not positioning for a black swan to give me the correction. I'm just positioning for, do I get a discount on the S&P by 5%, by maybe 5 to 10%? And if I can get that, can I position for it for more income? And if the answer is yes, then I'm taking those trades, right? But so far, this looks pretty steady. And, remember, going into the end of 2026, Powell's probably not the Fed chair anymore. By the time you roll into this one here, by the time you roll into like April, May of 2026, this is going to be a new Fed, right? This is a new Fed. And with that new Fed, you got to wonder if that comes with a hidden agreement that, hey, you're now Trump's guy. You're now the Trump administration's guy, whoever that Fed chair is. And is that going to force them to be more dovish, cut rates faster? So, market's pricing in 5 cuts now, but do we have a new Fed that's going to be more dovish? And all of a sudden we go to maybe it's still 5 cuts, but maybe it gets from 1.25 to maybe 2%, right? And the market hasn't priced that in yet. So that's the stuff that we don't know. And how much more vocal is Trump going to be about a new Fed chair? I don't know. It's already starting to swirl. Powell's probably not going to stick around for another term in May, right? So, and that's, somehow it's like if he makes it that far, I think he will. I think that'd be crazy and very disruptive if we fire Powell, but I don't think that's even possible. I think it's independent. There's too much power, and it's probably not worth the headache. So look, the Fed's going to cut rates, whether it's once or twice the rest of this year, whether it's still like steady through the next 15, 16, 17 months. The Fed's on a good pace to continue to lower rates. Question is the bond market going to absorb it? Is the bond market going to take it? Is the bond yield market going to reflect it? And that's what we have to find out, because I don't know. I don't know if the bond market's going to like it. You look at U.S. 10-year. U.S. 10-year. Right now we're up for the last 3-4 trading days. So is this the big beautiful tax bill right here? Big beautiful tax bill being priced in by the bond market a little bit. Okay, so that shows higher yields. That shows higher borrowing costs. How on earth is that a good thing? Well, the Fed's got to cut. The Fed's got to cut. Well, the Fed didn't cut. The market was breaking here and having a panic attack. And then the Fed cut back here when the market rallied. This is the bond market, the bond yield market. So if we're seeing yields up, we're going to see bonds down. You can see that reflected in TLT. So I've been saying this, but the government can spend money, can add to the deficits until the bond market takes away the keys. And I do think that this year the bond market is probably one of the more important things to watch, because if the TLT makes fresh lows, I don't know if that's great for the dollar. I don't know if that's great for bonds. I don't know if that's good for the solvency liquidity of the U.S. moving forward. I don't know if that's a reflection on our short-term, long-term auctions. I don't know. But if it stabilizes here and we see a bid up in bonds and a yield drop, then maybe we have some risk off trading. Because the one thing that was really odd in 2025 is watching gold down, dollar down, stocks down, bonds down all at the same time. That usually doesn't happen, right? So what happens to the dollar during those cuts? I think that the dollar is entering in a pretty painful next couple of years. I think the dollar has every right to potentially have a relief rally. And to what degree? Well, the dollar could certainly come back to like this 100 to 101 area, right? We can come back and find support to become resistance. Becomes resistance, and then a larger trend occurs. Okay, that's one scenario that we have just a little bit of a pullback. The other scenario is maybe this is a high to low, and you parallel that, and you go high to low, and you just channel it. So can this come all the way back into here, come down here? Can it come up here? We've got all sorts of scenarios where it's like price action. I don't know what's going to happen. I do that oversold conditions on the dollar probably means a bit of a short-term squeeze, maybe a bit of a relief rally, maybe some corrections, maybe overcrowded trades start to take some profit or something, right? The asymmetry is no longer to the downside selling the dollar. I think that's a terrible trade. So right now you have to give this a chance to take some profit, get a little relief rally, and then resume selling. I think that's a cleaner trade, right? So even if the dollar pulls back, I still think the overall cycle is going to head lower. I think dollar going down to 90 over the next few years is not that hard to believe. I think the dollar heads down, but this also gives global flows a lot better chance. So this gives the Eurozone a chance to see their indexes do very well. If you're in a Europe-based ETF, it's doing well this year. If you're in China, if you're in India, if you're in emerging markets, Brazil and Latin America just broke recent highs. These are all good things. Dollar getting weaker helps those, right? And so as long as you don't have like a big risk off event is usually what gives the dollar all of that liquidity back. That's the milkshake theory, right? So the big question is well, what about gold? What about Bitcoin? What about non-dollar assets? Well, that remains to be seen. Okay. But a pullback on the dollar there, does it stall, stumble, and then resume? Maybe it's a range. right? Maybe we go sideways, 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 but the bear market is still alive and well. It's just a matter of timing and confirming those entries. So, if the rates are going to be cut, which a lot of central banks have been cutting rates, the dollar has not, the Fed has not, right? The Fed has been waiting the longest, probably got the most mileage out of talking through rate cuts, and the market's pricing it in, which is why the dollar was weaker in the first place. Okay. But I still think that a weaker Fed moving forward, or a more dovish Fed moving forward, especially if Powell's no longer chair by May of next year, I think the dollar will continue to get weaker, which ultimately will probably fuel some global growth and global flows. But does that help, U.S. stocks and U.S. companies? Maybe. Does it help the bond market? Maybe. I don't know. It's really a weird correlation. This is why part of it is I like indexes. I like options on everything, and I like gold and silver and Bitcoin and some commodity exposure. I think you have to be in something other than just stocks. I think you have to have some type of diversification. Non-correlated assets. Energy is a non-correlated asset. Okay, oil and a bunch of commodities are non-correlated assets. So the S&P can be all over the place. It can melt up, it can go down, but oil and energy and commodities are kind of going to have their own cadence and rhythm. And I'm not exactly sure what it is right now. I don't have the pulse on that, but it's something non-correlated. So I'm interested in at least trying to position for something. All right. So CLOV, I don't know, man. I looked at the stock. I don't know what to say, but I think it was a SPAC. Fundamentally unprofitable, not becoming profitable for the next 3 years. It's trading way below estimates. It's got some good fundamentals on the discounted cash flow. Price of sales is dirt cheap. Fair value at $11 is trading at like $2.50. I mean, it's a cigar butt if you ask me. You want to toss some money at it. It's a one-off trade. Maybe it pops up to $5. Maybe you double your money, right? Maybe it pops up to $5 or $6. Cool, great, get out of it. But fundamentally, I have nothing good to say. It's just it's out there. It was 80 cents. Now it's a couple of bucks. It had a run. Now it's melted back down. Do some research. Okay. Dollar Swiss, CAD Swiss. Let's take a look at currency strength. So dollar and pound on top today. We've got Aussie, New Zealand, and Japanese yen on the bottom. So dollar Swiss, a little bit of gains today. That's fine. We haven't really a trend line yet. Let's take a look at some currencies. Still pretty. I mean, I have not seen outside of maybe a one-off, maybe a pound day or Japanese yen day. I have not seen this vertical axis on currency strength over 100 in a long time. So we have I would say, pretty choppy, quiet, low volatility, medium at best volatility for Forex. Something tells me that that's subject to change. I think when you're sitting at these like kind of boring volatility levels and you're not really getting, I mean, even what's like pound Japanese yen? I mean, you're getting 110 pips on the Japanese yen. Like the pound Japanese yen is, I mean, that's usually one of the highest moving currencies, 150, 175, 200 plus pips a day. You're getting 110 pips. Euro dollar, we're talking maybe 50, 60 pips a day in euro dollar. So we're in like a pretty low volatility environment in Forex trading. Not saying it's a bad thing, but man, something tells me that by the time we roll into post-summer trading, when it's like end of August, September, just don't be surprised if this starts to increase. We'll start getting some bigger moves. We'll start getting some hundreds on the upside and downside. We'll start to see some 150 to 200 plus point days in currency land. Usually that's not a good thing. Honestly, if you have an increase in volatility, it's like, I don't know what the basket is. Maybe it's the dollar. Maybe this is a flashback to, August of 2014. I remember August 2014 because it was crazy low volatility, and all of a sudden the dollar got really strong in a couple of months. So we'll see. But volatility changed dramatically. We saw like double the volatility over a couple of months. Okay. All right. If I'm hoping I'm answering a lot of the questions. Yeah, the dollar and the cuts. I mean, I think the dollar is still set up for like a pretty nasty longer term bear market. Like I said, even if I'm giving this all the credit in the world, this market at best maybe pulls back into like this halfway point or pulls back into equal highs and it just becomes a bigger range. But I think if you're patient into like this resistance area or this resistance area or this resistance area with confirmation, I think the ability to sell this back down to lows, sell this back to lows, sell this back to lows, I think the dollar has a good opportunity to still be a great sell. It's just not right now. I don't think the dollar sells a good trade. Okay, Adobe. I'll take a look at that one for Oliver. Adobe is at 376. Adobe fundamentally, I still like Adobe. I know it's been in the AI space a little bit here and there, helping. I mean, Snowflake wise looks pretty good. Not a lot of risks on it. Checks a lot of boxes. Not terribly expensive. I'm sure there's some peers that are cheaper, but I mean that's looking good to me, right? Discounted cash flow at 560, still have some upside potential, and cheaper than some of its peers. Now, are these like exactly the same space and same industry? Not necessarily, but Adobe is a lot of places. A lot of places. I kind of love. I mean, it's expensive. I don't know if I have any Adobe on right now. I think I wrote it down to look at it. Let me go here. So Adobe, I don't have it. Part of that's because I don't really want to own shares of it. If I did, I would say, owning shares at like 275 wouldn't be bad. We've got COVID lows back here at 255. It's low enough now after these recent corrections that we could probably get bear call spread. How long did that take, Dean? You should have been out of that pretty fast, yeah? That bear call spread should have been paying pretty nicely by around noon, shouldn't it? It was pretty good. Yeah, our bear we did the 62.80. That would have been, I mean, that's worth pretty much full profit now. The final 10 minutes, but yeah, I mean, we grabbed $100 a day. That was good. Adobe is down from the all-time highs, down around 45%. When we had the March and April correction, it was down about 53%. Now, I have the capital for this trade. Just depends on the premiums. Could I get something around the 250 level on Adobe? Probability of profit is probably pretty high, if you ask me. Okay, Adobe. The IV rank is really, really low, which I don't love. It's an expensive stock, so any type of nasty pullback or drawdown, it can be bad. We do have Prime Day, okay, planned acquisition. So we got some regulatory issues out of Adobe, Shopify, Adobe, which e-commerce stock is better. How is Adobe in e-commerce? I would not have put Shopify versus Adobe on the same stage of like comparing stocks. Adobe to me is like graphic design, AI trying to make, anything branding wise better. I mean, Adobe being Hollywood, right? All your fancy edits and producer stuff is all Adobe. Anyway, 270 or 250. Let me see what I can do. So if I went out to the end of the year, 250. So if I did a 260 by 250, I'm going to have to tie up some capital. But for this trade right here, there's about an 87% chance of profit. Okay. Could I own shares of Adobe? Yes, I could. What I'd own them at is around $230. I get $800 of credit on the trade. Doesn't take a lot of buying power. It's an income opportunity. We do have earnings. I know there's going to be potentially a pullback there, but 250. I mean, 250 is COVID lows. I think fundamentally it's okay. I mean, this is why I would say as long as it's staying above like 270, I like the trade. So a 250 or 260 by 250 is not bad. I like this income play. I could repair the stock if I had to own the shares. I could take this on a couple of my larger portfolio margin accounts and sell it at the money and try to get. This is the downside is you don't get a lot of premium on this, right? I mean, this is a stock I would own for like 200 and some dollars, and I'd be lucky to maybe get $7-8 on a 30-day call, which is enough to lower the cost basis, but it's not high premium. And I mean, if the stock's still down 41%, 45%. How is the IV rank like lower than this? This is a really, really low volatility rank. Overall, I don't think it's a crazy high beta. Let me see what this beta is. It's 0.93. So if we have a decent correction in the S&P, the stock would have to drop 34% more. I don't know. I'm going to write this one down. I'm not going to do the trade here in the next 7 minutes, but I'm going to write down Adobe. I think I take it in my higher margin accounts. I have some of the capital to do that, but also I have to remember if I own the shares, I got to make sure I have the buying power for it. So if I have to allocate, 20, 25 grand cash, it's like I know I'd only take about $12,000 margin, but still, I'm just going to make sure I'm not like eating into a margin situation. So That account should be fine. 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 These accounts are probably fine. This one's questionable. I don't mind doing it in this one. These are pretty easy to repair. So let's say I pull in like $8. 1, 2, 3, 4, 5, 6, 7, 8, 9. I make $7,200 on Adobe by the end of the year. It's better than a stick in the eye. It's got a pretty decent probability to profit. If I'm way down here towards December, I mean, it's at the expected move of, what's it? Maybe I go $500. Maybe I take this down a little bit. So that's, if I get $8 on this one, it's not too bad. That's a 10 delta. I mean, if I go lower and lower, it's like, okay, so if I can make $500 on the trade, this isn't a bad position. Way below the COVID lows, 40, 50, 60% off of all-time highs and a single digit delta, which based on the current option chain could be good. But there is always that potential assignment risk. If I took it on these accounts, it's because I have the capital to repair it. Okay, how about leaps on it? Nah. I'm just giving myself a wide margin for error because look, leaps, you got to be pretty confident that with leaps that direction's going up. If we go into like a chop fest, leaps are gonna over 6 months, 9 months, they're gonna suck, right? Selling premium, ratio spreads, if price goes sideways, I can still maintain and preserve my line in the sand and maintain my profit. Time works in my favor. So I'm probably not doing lots of, directional plays right now outside of just, establishing the line in the sand and selling some premium. So I'm going to write down Adobe, potentially a 1218 trade somewhere between like the 230 by 220. Let me see. I want to say I talked about this in my project options edge, but I didn't take the trade. I think I talked about it as one that was on the radar, but I didn't take the trade. It's not my spreadsheet. So anyway, I don't mind this one. So this credit, again, it's like bid ask is pretty wide. So if I went 240, like see how much that jumps. So I'm gonna have to play with the prices and figure out what's fair. Obviously, if I was getting like $7, $8, $9 of credit, I would take the trade because I think that's a 92% chance of profit plus the plan B is repair it. But it does take up capital. So these are going to be all margin accounts where I can take the buying power down, but also own it, repair it. If I was assigned, I would keep it and not take a loss on it. I'd flip it, right? So anyway, I'll put a pin in that for tomorrow. Adobe looks pretty good for a trade I'm probably going to take for my project options edge. Good stuff. All right, we just have a couple more minutes here for the close. Here's the tail of the tape on the day. Market did find like a 1.2% correction from the close on Thursday last week. So there's your close on Thursday. Market was down over 1.2% from high to low. We did bounce back a little bit. We're back up to 62.30, a little bounce off of those floor levels. Here is some intraday gamma. 62.25 and 30. Price did come back above. This is what I was telling traders this morning. Don't try to pick the bottom because we could certainly go over 1%. We haven't had a down day in weeks, like a decent down day. So S&P is down 0.8%. Nasdaq is down 0.76. Interesting, S&P is down worse. Dow is down worse, 0.996 in the Dow. Russell down worse, 1.57. So Russell is the lagging index today. The Dow is right behind it, two of the worst performers. Nasdaq is the least worst performer. Q's down 0.8, S&P down 0.8, and I guess about the same. I was looking at SPX down 0.86 and NDX down 0.84. So Nasdaq and S&P kind of the same today. So, all right. Any final questions here for the last few minutes? Tomorrow's a new day. Let's see what we can get. Adobe's on the radar for a trade maybe in like the 250 to 240 zone. Just an income trade. There's some earnings in September. So even if I were to go out to the end of the year, I'll take the chances on an earnings play. A lot of the earnings here, you see a lot of green in earnings. If they're even mentioning AI, I would hope it's up. I think the market is still due to have some pullbacks and corrections. Maybe that puts pressure on a lot of things as a whole. But are we going to fall so fast that we take out, COVID lows? And I would say probably not. So I'll just trade the mechanics. I think I can turn it into something profitable. All right. Any thoughts on currencies? Gold, silver, Bitcoin, stocks. We good? All right. Couple things to note this week. On Wednesday, I will be talking through some news breakers. I'm going to be on an 11 o'clock session talking about some news trades. We do kick off earnings season. It's light this week. It's a little bit more important to watch next week because financials kick us off. It's a big gauge for the outlook of the quarter. Usually, if financials lead pretty well, the market's kind of excited. If there's any type of apprehension, if there's any type of you know, cryptic language from financials for any type of guidance, like the market could be really sensitive to, less than stellar earnings this quarter. Okay. If you did take the ratio spread, would you typically hold it and expire for income? Yep. There's two ways that I would take that trade. One is if let's say I get filled for, $5 credit, and I'm not sure what the fill is going to be, but I'm showing like anywhere between $5 and $8 credit. I'll just say $5. So if I did a ratio spread, the numbers would be something like this. I have a 12/19 expiration, say 240 buy put for one, and then a 230 sell put for two contracts, and I pull in $5 credit. Okay. Now the most important thing is that this is a 240 by 230 bear put spread, which is a $10 max profit trap. That's the beautiful thing about a ratio spread is if price goes down, I still have a potentially $1,000 winner. If we're in between 240 and 230, I mean, if we're below 230, I get $1,000. But if I'm below 230, I get the assignment as well. So 230 is a leftover naked put. So I'm willing to own the shares. Okay. If you don't want to own the shares, then consider managing the naked put to a 200 to 300% stop loss. Okay. So let's look at that trade. If I go 240 by 230, right now that put is offering $7.60. So if I get filled for $7.60 on that put, if it's trading for $15.20, I might just want to take the hit and take the loss of a $760 loss. Okay. Now that can happen with a swell in volatility. That doesn't necessarily happen like, oh, price is way below 230. I get a. You can have a big jump in volatility, and your put option could jump from an 8.4 IV rank to a freaking 30 IV rank, and this will blow out that credit. So your 760 credit could be trading for $15, $20, $25. That's painful when it's just a volatility swell. That's what happened last July to August, right? That's what happened a bit in December. That's what happened this year in March and April. IV jumped a ton. So, you got to be willing to say, like, look, if I'm going to take this trade, I'm not going to close out that put based on a volatility jump. I'm going to close out that put based on I own the shares. I'm willing to keep the shares. I would own them at like 215 because I would get assigned at 230. Let's say I can get, $5 credit here plus my $10 trap. That's a $15 discount. So I'd own it at 215 or so. That's a big, big, big difference. I mean, that's about a, I don't know, 6 or 7% chance of assignment or risk on the trade as far as like letting it expire. But what makes me nervous is why is IV so low? It's a really, really low IV. So any type of drop to the downside, any type of overreaction, if this IV jumps up to like 15 or 20, these put options could be exploding higher, and that could just put a lot of risk on my trade. Even though I might not be at risk because the stock would have to drop $140, and that's my line in the sand. But I don't want to see the implied volatility jump aggressively. Make sense? So anyway, I will decide if I think that's a good trade. I think it's okay for an income trade. I think it's okay for the capital to manage it. Okay. All right. I will Let you go from here for the final hour. Just after 4 o'clock, market's closed. Let's go back and do this again tomorrow, and I'll see you then. Okay, so we'll talk more Adobe tomorrow. I might take the trade. If I do look for it in my project options edge, tariffs won't stack. Okay, I don't even know what that means. I mean, Besson said that maybe we extend on some circumstances out to August 1st. We still have a July 9th deadline. That's obviously just a couple days away. We'll see what it looks like, what the market does this week. There's not a lot of fundamental news this week. We have FOMC minutes on Wednesday. There's a bunch of low impact news this week. We have some unemployment claims on Thursday. Next week is inflation with CPI, PPI. Earnings season kicks off as well. So, I mean, in a way, this is kind of a nothing burger week, but you never know what price is going to do. Could be a choppy week, could be a nothing week, but we're already down, a little bit to kick things off. I hope there's a little bit more. I really do. Just come on. I mean, give us just a freaking pullback. I mean, a pullback isn't that hard to ask for. I just think it's funny how everyone panics when there's a pullback because, oh my God, what's happened? Look at all this stuff. It's just needed. A technical correction is needed, for crying out loud. So a dip or a pullback is fine. I'm happy to scoop up. I'm happy to buy some more. I'm happy to position for it. But just the market melting up to all-time highs to me just screams like I got to have some protection. I got to have some puts. I got to have something. I got to have some hedges because it just doesn't go up like this forever. It's silly. So holding Dell and IBM. Yep, I sure am. Those are ratio spreads. Yep, Dell. I'll just simplify this. So Dell still holding. It's up around 46% right now. And IBM still holding 12%. So yeah, still holding them. They're fine. Not worried about them.